Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Gerard Smith, Vice President and Head of Product Digital Assets at Nasdaq Market Technology, which he joined in June 2022 after 3 years heading post-trade at Hong Kong Clearing and 10 years in collateral management services at LCH ClearNet. A starting point for our discussion today is the global survey of post-trade developments that Nasdaq has just published with ValueExchange. Gerard, thanks very much for joining us.
Hi, Dominic. It's great to be here. Thanks for having me.
Now, Gerard, you're an expert in managing change. One of the things that comes out of the Nasdaq ValueExchange survey is that most financial market infrastructures are still running on legacy systems, and those legacy systems are eating, and this is the percentage cited by the survey, 78% of their budgets. The survey also finds that most of those FMIs are looking at a major system overhaul in the next 5 years. I wonder whether those two statements are contradictory. Is technological transformation actually possible when roughly 80% of your budget's being eaten by your legacy systems, but you know that you need to change? Is there a contradiction here between the need to change and the budgetary constraints?
I think there probably is, but if we break that number down, so that high number, 78%, if we break that down, there's about 45% of that is spent on improving and supporting existing systems, and the rest, about 35%, spent on what we would call transformation, so replatforming and replacing. But in some of those systems are over 10 years old, and many of those systems, in some cases, are over 20 years old, especially when it comes to components like settlement and corporate actions. But the big picture is that not a lot of resources is available for innovation and growth. So people are dealing with regulatory change. They're dealing with things like mandatory change as well, things like T+1, for example. So overall, it's kind of difficult to focus your capital expenditure on growth and innovation in such an environment. So it's also difficult to kind of like create business cases for growth and innovation when the cost of changing your legacy platform is so high, and often people are reluctant to change those platforms because they're scared of breaking them. So in that kind of context, transformation is a must, and I think the kind of like the high number spent on kind of like basically just kind of maintaining legacy systems speaks for itself. There's little room for anything else at the moment.
Anyway, it sounds like it's difficult to do things for internal reasons, and then of course there's the customers, the users, and there's a rather fun quote in the Nasdaq ValueExchange survey, which I enjoyed it anyway, from an official at an exchange who explained that, and I'll quote directly, "When we launched our new ISO 20022 corporate action feed, the first market participant we spoke to asked if we could make it look like ISO 15022. So that anecdote illustrates one of the messages out of the survey, which is that the users, by which I mean, in the case of exchanges, domestic brokers, in the cases of CSDs, sub-custodian banks, those are also a constraint on technological transformation of financial market infrastructure, simply because they don't want to have to invest in, say, a new interface. Is there a way of getting around that reluctance to invest on the part of users and customers?
Look, I think there's two sides to this, obviously. So perhaps FMIs haven't done a great job of explaining the benefits of certain changes that they're making to their participants, and therefore you end up with quotes like that. But often FMIs are in a kind of favorable competitive position, and that I find sometimes means that there is a reluctance to change and a reluctance to kind of like disrupt the markets that they've been running for many years. And then on the other side, some participants are reluctant to change. If your FMI is telling you that that there's a significant upgrade that you need to, or innovation within their particular market, and you're running on old legacy systems, then perhaps the cost of change for that is very high, and perhaps the benefit that you perceive from that is doesn't justify the cost. So there's often two sides to that. But if you think about this in terms of the future, how do you get over that problem? Then obviously you need modular systems, you need real-time systems, you need API-driven systems, and you need from a market from an FMI perspective, you'd be better to have small, frequent changes that are easier for your participants to adapt to and easier for them to accept. But obviously, you need to go through a kind of transformation first before you're able to be able to deploy a system like that, and to be able to have that kind of change cycle rather than large multi-year projects that are quite disruptive and eat up the budgets of your participants.
This question is related to the previous question, and it's based, I suppose, on my experience, particularly of talking to international sub-custodian networks about their relationship with CSDs around the world. And it strikes me that maybe users like that are, as a group, speaking with forked tongue. They complain that financial market infrastructures don't standardize their connectivity or their processes, so they're always having to adapt to local factors. If you're a bank working in 60 or 70 markets, you're always having to adapt to different interfaces to the local CSD, for example, and that drives up their costs, and therefore they're unhappy. But at the same time, you have this group of users who want everything to stay the same. But anyway, is it fair, the complaint that FMIs are not always responding as they should to the demands of their international customers to standardize, say, the interface to the system?
Yeah, I think again, it's kind of like there are two camps here. There are FMIs that kind of actively engage with their market participants. They have user groups, and they have committees and governance that make sure that whatever they're doing is accepted by the participants, and the participants feel like they have a say in what's happening. And then on the other side, there are FMIs that maybe are on old legacy mainframe systems that find it difficult to change, and there you get this situation where they don't invite change because they know the change will be costly and disruptive for their markets, and they don't want to raise expectations that if you're open to change, then you kind of open the floodgates to a whole load of requests from your participants that you can't necessarily meet. So I think there are two camps there, and it's probably quite specific to the market. And it is a difficult question to answer, but ultimately everybody will agree that you need to move towards kind of standard ways of communicating in securities markets. So CSDs that kind of have Swift interfaces and use ISO 20022, or even getting rid of kind of bespoke interfaces, moving to 15022 or 20022 is overall a good thing, and something to be encouraged. And ultimately, that might mean going through a lot of pain to get there, but that's going to end up everyone's going to end up in a better place if that happens.
One of the findings from your survey with ValueExchange delighted me, but it also surprised me, which is that the number of people inside these organizations, these FMIs, that actually understand how things work. In other words, they know how to settle a trade, they know how to interpret a corporate action without technology. Those sort of analog-minded people, the expertise that they embodied in their careers and their experience has disappeared, or they've been, in a sense, the people operating systems inside FMIs have been dumbed down, if you like. I was delighted by that because I've been around a long time myself, but I was also surprised by it. Was I right to be surprised? And if I'm not right to be surprised, what does that imply for operational resilience if all the people who know how things really work when you're not using a system have disappeared from the industry? Is that a problem?
You could put it that way, but I prefer to think of operations as the kind of the glue that holds the business together, right? So these are the people that you can see them as human APIs. They're the people that can join up disparate systems by doing rekeying and by doing four eyes checks and making sure that everything kind of like on a day-to-day basis hangs together. And often those people are the people that know the business of what they're doing, and not just like following a daily checklist or procedure. So it's important to have those people around, especially when you're embarking on a transformation, because if you've got a team of robots, then obviously they know what they have to do day to day to make things work, but they don't know the reason why they're doing it. And I think, but ultimately having people around that know those systems and processes and the business reason they're doing things, gives an element of flexibility when making change and when making plans and when doing new things. You may start off doing something in a kind of controlled manual way, and then in order to get something live, and then replace that with an automated way of doing it. And I think it's really important because there's obviously a lot more focus from regulators on resilience, and systems that are SDP are more resilient than systems that hang together from people rekeying and whatnot. So, and we've also seen the rise of kind of more robotic process kind of implementations. Perhaps in the future we'll see AI play a role in here, but there is a risk there that we have aging systems and we have aging people that know how to work them. They're getting old and retiring, and that can be a big issue.
You just mentioned artificial intelligence, which is the ultimate form of robotization, I suppose. Is AI in the FMI space, at least, is it overhyped, or are there concrete use cases? One we often hear about is the ability to predict settlement failure, for example. But do you see that as a genuine use case, and do you see other use cases for AI?
I think with AI, as with other new technology, there's always that hype curve. I'm not sure where we're on it at the moment. I think we're kind of perhaps at the beginning of that. But here at Nasdaq, we're exploring ways of using AI. One, to speed up the way in which we do development, and two, we're kind of exploring how we would introduce AI into our various products. So as a head of product, we're definitely looking at ways in which we can introduce AI. And that was a good example that you gave. Perhaps we can use AI to predict settlement fails, or to perhaps predict how we can use large data sets like transactions that are queuing up for settlement, in order to be able to optimize the way in which we do settlement in the future. But what's really important for corporates and FMIs and everybody is to make sure that they have governance around the way that they use AI, so that any adoption of AI within their firm can be done in a safe and resilient way.
Something else the Nasdaq Value Exchange survey picked up is that financial market infrastructures are concerned about regulation. That surprised me, in the sense I felt we'd passed the high watermark of the re-regulation of financial services after the great financial crisis of 2007, 2008. So I wondered if you think that by citing regulation, the respondents really are worrying about the transition to T+1. My question A is, do you think that's what they mean by regulation? And B, is the transition to T+1 becoming an excuse for not investing in other forms of technological transformation, which you've got to throw the whole budget at this urgent priority?
I think from the survey, I think we bucketed together regulatory change and mandatory change. So T+1 would kind of fall into that bucket of mandatory change. And T+1 is a really good example of a change that is impacting the whole value chain, right from asset manager to broker, right through to kind of global local custodians down to the CSD. Its impact is quite profound on all of those places. So I think it's important that systems that people are assessing at the moment to see whether they can cope with the T+1. I think if those systems are real time and event driven, I think that will mean less change for the firms that have implemented those types of systems ultimately. But on the other hand, we talk about T+1 as a major change across the industry, and it is, no doubt that is, but we have done it before. India is already on T+1, and for many years people have been dealing in the China market, which is the second biggest equities market in the world, which is a T+0 environment. So at the end of the trading day, you've got about 4 hours in which to settle all your trades. So I think that we can learn lessons from the way in which firms have managed to cope with T+0 in China, mostly done through the Hong Kong Connect product. We should learn from that, and we should see what the kind of the consequences of moving to an accelerated settlement time has meant in those markets. And if you're really interested in that, I try to draw some comparisons between how it works in Hong Kong and China and I set those kind of like the challenges and the consequences out in a paper that we published back towards the beginning of the year. So highly recommend that, even if it was written by myself.
Always boost your own work. I've made it a rule of life.
Just blowing my own trumpet.
Yeah. And I guess T+0 is the destination towards which we are ultimately trending.
Yeah, but there's it's great when people start saying, okay, we're moving to T+1, and that's great, and what a great thing that is, and because ultimately you pay 1 day's less margin at the clearinghouse, and isn't that brilliant? But I was just discussing this the other day, and one of the consequences of that is if you're a firm in Europe dealing in US markets, then you need to do FX in order to have the dollars available in order to settle those trades. And if you do an FX swap, then that will typically go through CLS, which means less risk, less counterparty settlement risk. But if you're doing those FX swaps in future, because we've moved to 2+1, those FX swaps can't go through CLS anymore. So you may have lowered your initial margin requirement in the US, but now you've got settlement risk against your FX counterparty. So not to mention all the system changes that go with it. So there are consequences of moving to T+1 that are market wide and should be thoroughly analyzed and thought through before making a move like that.
And I guess compromises will have to be made, which brings me to a broader question about compromise. You mentioned in one of your earlier comments that it's better to make lots of small changes frequently than try and bet the bank or the CSD or the exchange on one giant leap into a technological future. So inevitably, technology is going to be at various stages of development in different parts of your business and different parts of your interactions with different client groups. So is there an obvious viable sort of technical compromise between legacy or traditional technologies and the technologies of the future, by which I mean blockchains, distributed networks, centralized networks, smart contracts, AI? Or is there a stable technical compromise which is visible and can be arrived at, all that vary from firm to firm?
Yeah, I think there is, and that's the kind of philosophy that we'll be driving here at Nasdaq with respect to the work that I'm doing on digital assets and on carbon as well. And so the key to this is flexibility. So I like to think of the platform that we're creating as having 3 different layers. First of all, there's the application layer, which is driven by smart contracts. That's a given. Secondly, there's the DLT layer. So there you start having options. So when you speak to the customer about what they're seeking to achieve, you need to talk about two things. You need to talk about the DLT layer, and you need to talk about the actual ledger underneath it. So at the DLT layer, there's a choice. Do you want to have a single node, or do you want to have multiple nodes because you want to distribute processing in this particular workflow or this particular process? So that's a question. And then finally, there's the ledger layer. So the option there is, do you want to run smart contracts on a database, or do you want to run it on an enterprise blockchain? So there are choices in how you begin to deploy the technology, and often it's a question of what is the use case and what's most appropriate in terms of the technology and how you deploy it. And secondly, cost comes into this. If you want to distribute nodes and if you want to run on an enterprise blockchain, then obviously the cost is higher than if you have a single node and run on a database. So my plan is that the platform that we deploy for digital assets, for issuance, settlement, and custody of those assets, gives the customer those types of, we have that conversation with the customer, and the customer understands the options that they have. And maybe they want to start that journey with smart contracts on a single node, not a database, but that doesn't prevent them from moving to a more distributed topology, an enterprise blockchain at a later stage, if that's what they want to do.
Since you brought up blockchain and digital assets, could we talk a bit about tokenization? And this is another area where a compromise, I suppose, is emerging, in which existing asset classes are being tokenized, what I'd call asset-backed tokens. So the underlying infrastructure and intermediaries remain in place, and you're just making it easier to move assets and cash around. And that is distinct from the ultimate genuine form of tokenization, in which every asset, whether it's debt or equity or a commodity or whatever it is tokenized and isn't available in any other form. So it's a genuine native token issuance. Do you think that what I'm describing here is a transitional stage, which we go from asset-backed tokenization, but our ultimate goal is to move towards native token issuance? Is that transitional stage either necessary, or is it slowing things down? Should we be being more ambitious about trying to move to a tokenized future?
That's a tricky question, Dominic, and I think you're probably right, on the right track. I don't think it makes sense to try and boil the ocean by introducing native tokens across an entire ecosystem. I'm not sure how you would go about doing that. So what we see a lot in the industry is people beginning to introduce asset-backed tokens, and people beginning to introduce the technology into areas of their value chain or workflow that are less disruptive for the participants of that particular ecosystem. So I think it makes absolute sense to make a start, and to make that start in areas that are least disruptive to your ecosystem. And as your competence builds, and as the industry evolves, and as ecosystems begin to be created, or ecosystems that exist begin to be transformed and replaced, I think we'll see that. I think that's the kind of evolution that we'll see. So it's more evolution than revolution, as they say. But what's really important is that market participants begin to adopt the technology that FMIs are deploying. So I think that from a purist point of view, you should be going directly to native token issuance. But think about that with respect to the entire ecosystem of, let's say, a bond. It's completely disruptive to the entire FMI community, and you need to start small and take baby steps and continue that journey in a sensible way.
Something that has emerged as an obstacle to progress on the path to tokenization is interoperability, and not just interoperability between the various different layer one blockchain protocols, but between blockchain networks and traditional networks, particularly if we're going to have a prolonged transition where the old world stays in place for a prolonged period of time. Now, is the solution to that interoperability an equally old-fashioned solution, i.e. standards, sort of Swift fixed style message standards, or is it something new? And the term I applying to this would be interoperability by design, by which I mean that every asset which is introduced onto one of these blockchain networks is designed, if you like, it's issued, it's traded, it's custodied, it's serviced in a common technical digital format or shape. So, and I'm not sure I'm expressing interoperability by design very well, but I hope you understand what I'm saying. Is it to standardize exchanges of data, or is it to somehow build interoperability into the very design of the things that are being issued and traded and custodied?
But I think by default people are thinking in that way already. So I mean, look, ultimately, I think a world without adapters and translators all over the place to allow interoperability between lots of disparate systems would be a great thing. But at the same time, I can't imagine that one standard will win. So perhaps we'll have one dominant standard that's a kind of, a benevolent standard that, everybody, doesn't have an axe to grind about using. But ultimately, interoperability is inevitable as well. So, and I think that people are thinking about that in terms of and designing that way already to ensure that whatever they build can interoperate across different blockchains. So we see that especially when it comes to securities and payments. Often a securities infrastructure may be built on on a certain blockchain, but the payments infrastructure is built on something completely different. And there have been lots of use cases where people have proved out that you can achieve DVP across different blockchain systems. So I don't think it's necessarily a huge problem, but ultimately it would be better if if we move towards a common standard. But I'm not sure that's achievable.
You mentioned that tokenization initiatives are tending to focus on areas where the disruption will be minimal and the returns are likely to be highest. And one of the areas which you see that very phenomenon happening is securities financing. And securities financing matters because it's how banks fund themselves. And it is obviously, with rising interest rates, getting more and more expensive to fund a bank. And so we see multiple tokenization initiatives aimed at that area. We've got the JP Morgan Onyx intraday repo using the JPM coin, their tokenized deposit. HQLAX has published a collateral management platform. Broadridge has a repo platform which is attracting business. We've got a currency swap platform from Fintium. We've got Fragmos with this initiative in uncleared derivative processing. But so there's multiple initiatives. They're all a bit fragmented. They're not really achieving scale, and certainly not scale on a global level. Is there some way that you can see where the almost palpable savings in terms of cash, collateral, capital can be unlocked on a global scale?
I guess firstly, it's not necessarily an issue of the adoption of the technology or the deployment of the technology. I mean, in certain of these cases, we're talking about kind of cross-jurisdictional capital flows, and there's an enormous amount of legal and regulatory work that needs to be undertaken by firms in order to ensure that there is a sound legal basis, and that bankruptcy rules and default scenarios are fully understood before these things can progress. And that's not something that happens quickly. And regulators are definitely involved and trying to understand what the technology means for their FMI ecosystems, etc. But often the technology is, developing at such a pace that it's difficult to keep up, whether you're a regulator or not. So that's one kind of like barrier that slows down the innovation and whatnot. But it's an important thing that needs to be considered, and not something that can necessarily happen very quickly. And secondly, we need to think about capital markets are a really interconnected ecosystem. So whilst you get these examples and pockets of solutions that bring efficiencies to kind of discrete areas, there's often a need for increased adoption in order to get that kind of ecosystem effect that you're talking about. So, and sometimes that can be a combination of getting participants to join that platform, and sometimes it's about the scope of that platform or that use case being increased so that participants can see significant benefits. And then back to the last question, sometimes it's you're never going to see significant growth in that particular example unless you kind of grow the ecosystem and you start to interoperate with other platforms. So you see a lot of announcements about people having issued a digital bond, for example, but unless that bond can settle across systems, be used as collateral, be used as repo, etc., then it's a kind of interesting experiment. But so what? You need to be able to, and I don't say that in a flippant way. I mean, it's a significant step forward. But until you start joining the ecosystems together and creating something new and transformational, then it's hard to see how the benefit of this new technology will be brought to bear across the industry.
I'm going to ask you in a minute about voluntary carbon credit markets. So I know that's a particular interest of yours. But before we leave the securities markets, could I just bring up something I found very interesting in the Nasdaq ValueExchange survey, which is that an awful lot of the blockchain innovation dollars which it identified have been going into the bond markets. You've raised that a couple of times in this conversation. You've got a client in the shape of the Chilean CSD actually doing something in the area, but it seems to me a lot of investment has gone into tokenizing the bond markets, to crudely summarize it, without really changing that much, and without I know a lot of the dollars have gone into the primary market, but nothing much seems to have changed. We don't seem to be getting the market participants excited about it. At least one interesting venture in the sphere is actually no longer with us. So some of these initiatives have failed, others are not succeeding as people had hoped. What's really going on in applying blockchain to the bond markets, do you think?
Honestly, I think people start with bonds because they're easier than equities. But I think, look, you need to look at this through a kind of long-term lens, and the same goes for cloud. Within financial markets, digitization, tokenization, using blockchain, plus cloud are, you could call them mega trends within the industry. And so those in the industry that are making themselves ready and putting themselves in a better kind of position in order to capture future opportunities, I think are perhaps being very wise. And DCB is a great example, the Chilean CSD, where they're using our technology to allow them to digitize securities, whilst continuing to service their traditional market. So that's great positioning from them, because as these things do evolve, and you have to kind of like think about these trends, and it is a trend, and some people would say we're at a tipping point, and for mass adoption. I'm not sure we're in a tipping point just yet, but those people that have positioned themselves to start exploring, taking advantage of this technology, building their competence internally, starting to introduce it into elements of their technology stack, I think are positioning themselves much better than those that are doing nothing in this space.
Talking of DCV, I'd like to ask you about CSDs and tokenization more generally, but I also promised I'd ask you about the voluntary carbon credit market. So I'll do that first. Is there a way in which tokenization can help the development of the voluntary carbon credit markets? They've acquired this reputation of being a bit of a Wild West without much reliable infrastructure and data services. But do you see tokenization being able to help the market grow and become more sophisticated?
So I think you know, the reputation as being a Wild West is a little overblown, and there's certainly a lot of initiatives around, you know, ensuring integrity in the carbon markets. But we've been working on a carbon token taxonomy with the help of the Interwork Alliance. So we've created a taxonomy which will allow the creation of carbon tokens across the very many different types of carbon credits that are around and issued at the moment. But you know, ultimately, the truth is that carbon credits don't need to be tokenized. There are many carbon registries that work relatively well as they are at the moment without working on you know, tokenized carbon platforms. But going back to the point I made previously, I mean, the key is flexibility. And if you can use smart contracts for sure, then the customer decides whether or not to actually tokenize the asset by using DLT and putting it on a blockchain. And I think when it comes to carbon credits, there is, you know, because it's a new asset class, people kind of say, okay, new asset class, new technology, carbon credit therefore must be tokenized. And I don't think that's the case. But at the same time, with the technology that we're building, we're ready to be able to handle it in a tokenized form if the business case and if the particular carbon registry entity that we're dealing with wants to do it that way. So again, it's just down to choice and deploying the technology in a flexible way.
Mm-hmm. Back to CSDs, DCV is obviously one of 150 odd CSDs around the world. You've got CSDs inside the Nasdaq group itself. Which areas do you see CSDs when they look at the kind of things they do? They do issuance, they do settlement, they do custody, they do asset servicing. Which areas do you detect CSDs looking to focus their tokenization investments on?
I think it starts with issuance because that's the area for CSDs which is least disruptive. So we see examples of issuance of the token and then effectively reflecting the issuance of the token back into the traditional CSD world onto the individual accounts of account holders. So that's a good place to start. Seems a sensible, you know, least risky place to start for me. And then we can imagine that, you know, after competence is built, after the market has gotten used to the way in which that is done, you start to venture into the kind of the real core, you know, CSD functions like settlement, like corporate actions, etc. But you know, like I said before, that starts to become the more complex part. And then there are questions of you know, making sure that you're doing this in a way that's safe and resilient, and in a way that your market participants are going to accept and encourage, if possible. So yeah, I think, you know, as I mentioned before, I think issuance is a good place to start, and we see other CSDs and ICSDs taking that same approach, and it seems to be a sensible way of doing it.
One way of measuring the confidence level of CSDs is something you brought up earlier about whether people want to run one node or multiple nodes, or whether they want to run any nodes at all, or have somebody do it for them. Do you detect CSDs are ready now to start managing their own nodes on blockchain networks?
I think CSDs are ready. I'm not sure that market
customers
are ready. You know, I in conversations that I have, I see little appetite for customers to adopt their own node and perhaps kind of take that node into their own data center, for example. I think from a business operations technical point of view, it's complex, and it is transformational in your back office systems. And often these back office systems, if you're a sub-custodian, you'll often be a sub-custodian in many different markets, and so perhaps one market changing to a whole new way of operating is very disruptive for your system. So and not to mention the cost. So often the cost can be a prohibitor here. So I think what's more likely is that CSDs can distribute nodes that they have within their own data center for participants, and participants just API into nodes that are either nodes set aside for particular parts of the industry, maybe one node for custodians, one node for brokers, or something like that, or you just have a single node. And when it comes to CSDs, these are highly regulated, trusted entities. And so, before you go down that road, you've got to question whether or not a node topology which is highly distributed is really necessary. But at the same time, that can unlock quite significant benefits in terms of eliminating reconciliation, streamlining processes and whatnot. So it's often a case of pros and cons, and coming at it from that way.
We've covered a lot of ground. I have one final question for you before we let you go, Gerard, which is, what do you think will be the chief characteristics of the successful financial market infrastructure of the future, by which I mean maybe 2030?
Difficult question, but I think if you consider global post-trade infrastructure remains on legacy systems, legacy architectures, some of which are more than 20 years old, and increasingly they're patched together, complex web of financial market infrastructures and other intermediaries. Then if you marry that with the view that we're on the verge of something transformational, when we think about blockchain and DLT and the way that the industry operates in that sense, and bringing into that the equation kind of like new revenue opportunities plus financial pressures and regulatory pressures, I think those people that kind of start to embrace new and perhaps disrupted technologies will ultimately become the leaders of the new kind of like ecosystem providers. So I think of it that way. There's a lot of ground to cover, I think, before we move into 2030s looking like all financial market infrastructures are highly distributed and highly streamlined. There's a long way to go, but I think the path is clear. FMIs and their participants need to embark on transformation journeys, and Nasdaq's here to help.
Gerard Smith, thank you very much for taking the time to share your experience, your knowledge, and your ideas with the members of Future of Finance.
Thank you, Dominic. It's been good.